Well, good morning, everyone. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group, and welcome to the webinar, How to Take Advantage of IRAs Before the Tax Deadline. Again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Before we begin, this webinar is purely an educational webinar dealing with the general information in regards to individual retirement accounts, as well as IRA-based employer-sponsored plans. Entrust Group does not provide investment advice or endorse any products. And by the way, we do not offer any investment products at all. What we offer at the Entrust Group as a record keeper of IRAs is the platform as well as the documentation that allows for you, the investor, to choose the type of allowable investments to be held under an IRA, to be held at a custodian like the Entrust Group, to maintain the tax-deferred status of your retirement plans. All information and materials are, again, for educational purposes only. All parties are encouraged to consult with their tax or legal advisor if you have any specific questions to your situation, as well as your accountants or financial advisors, as well as discuss with them the types of investments that you are looking at, because the Entrust Group does not play a role in vetting out the investment. Pull in some of your team players, such again as your accountants, your legal advisors, as well as financial advisors before entering into any investment. Again, this course is working through the general parameters, so the rules in regards to individual retirement arrangements, but not specifically for the investment itself. We do have some questions already being posted, so please, for those of you who have some questions in regards to the materials that are going to be covered, please jot them down. And what we'll do is open up the phone lines later on in this particular course to answer those questions. Just to brief logistics, the seminar is supposed to last approximately an hour long, with the first 40 to 45 minutes devoted to the presentation of the material, and then we will open up the phone lines again. Not open up the phone lines, but answer the questions you may have typed in and sent in regards to the material presented. Well, the agenda for this course is, of course, we're going to talk a little bit about Entrust Group, and then we're going to talk about the deadline and what it means for IRAs, the tax deadline. The tax deadline is associated with IRA contributions because IRA contributions, some of them could be used as a tax deduction. And in some cases, individuals do not know how much they would have made until they file their tax return, which ultimately the deadline for that is the tax return due date. And if they are going to make a contribution, to determine the type of contribution you're going to make, the tax deadline is an important date. We're going to take a look at the overview of individual retirement accounts. We're going to review contribution, who's eligible to contribute, what are the limits, what are the deadlines, how do you make the decision to contribute between a traditional or Roth IRA. One of the factors that determines whether or not an individual is eligible is what we call taxable compensation, as the IRS terms it. I'm going to also call this what we call earned income. Not all taxable compensation can be used to support the contribution being made. In other words, an individual must have enough earned income in order for them to make a contribution to an IRA. Now, keep in mind, there are some people that have a lot of taxable income, but it may not be considered as what we call earned income. Those types of income is what we call passive income, and we'll go over what is and what isn't earned income or taxable compensation. As a matter of fact, we'll show you a chart that is contained in one of the IRS publications called the Publication 519. We'll also take a look at maximizing your tax refund. What are the explore, dot your I's, cross your T's. What are the possibilities of you being able to make a contribution to further increase your tax refund? We'll pull in some other tax favored accounts as possibly like your HSA, if you are covered by a high deductible health plan, as an example. Now, once a contribution is made, especially if you make it at the Entrust Group, well, what can you do with the money? At the Entrust Group, being a self-directed IRA provider, which means we don't offer any investments, but we allow you, the investor, to pick the investments that you'd like to put under the umbrella of the IRA that you have at the Entrust Group. And of course, the benefits of or the the main characteristic or the differentiator between a self-directed IRA provider and other IRA providers is the fact that the self-directed IRA custodian can hold other types of assets where other traditional types of financial institutions do not hold, such as precious metals, such as real estate, notes, private placements. So if you want to put a portion of your portfolio in those types of investments, they can't hold it at another financial institution. Well, that's what a self-directed IRA administrator comes in. We'll talk about how to get started setting up an IRA at the Entrust Group, and then we're going to talk about the questions that you may have in regards to the material presented. All right. First off, the Entrust Group has been around for over 37 years. I can't believe we've been around for that long. We are one of the leaders, if not the leader in the industry. There was a survey recently provided by one of the magazines that vetted out all the different administrators out there, and we're proud to say that we were on top of the list. Although we don't offer investments, again, in other words, for those individuals coveting traditional types of investments like stocks, bonds, mutual funds, CDs, or, those are the common types of investments sometimes some individuals look for. Although we don't offer those, we do offer a platform that allows for you, again, the IRA holder, to choose to, hold non-traditional types of investments under the umbrella of a retirement plan, which is a niche that we've had for over 37 years. We have over 22,000 accounts and numerous types of investments held under those accounts, with over $3.3 billion of investor assets in those particular accounts again. In other words, we've facilitated or helped individuals use some of their retirement dollars to invest in what they want, such as real estate, apartment complexes, notes, and so on and so forth. So, again, that's what differentiates us from other providers out there in the industry. Again, Entrust has a single point of contact, which is an 800 number, as well as which has customer service, live customer service reps that are very knowledgeable, as well as even some business development managers in certain strategic portions of the country, brick and mortar places where individuals could actually call, or in some cases maybe even visit, because they're actually located in that particular section of the United States. Now, we are one of the leaders in education. And what does that mean? Not only do we educate our staff, we also educate other competitors' staff in some cases, and we're proud of that. Of course, we don't, get into the nitty-gritty of their business, but they do get the information and training from us. Not all of them, but most of them do. We do have some courses that are approved through the Certified Financial Planner Board. We're an approved continuing education provider for the IRS, NASBA, and other designations. One of the designations that we work closely with is an American Banking Association designation called the Certified IRA Services Professional. So if you see an individual with a Certified IRA Services Professional, they've been vetted out by the American Banking Association to know more than what a lot of people would know in regards to individual retirement arrangements. And we hold a school once a year, or maybe even more in the future, that teachers could come in and train to be able to sit for that designation through the American Banking Association, again called the Certified IRA Services Professional designation. Our school is what we call the IRA Academy. We're going to hold one this year in Nashville, Tennessee, where our trust company is actually also chartered. Again, we have nationwide offices. Not in all states, but regions of the United States. We also provide a national continuing education program for a lot of the designations I've already mentioned, and we provide sometimes for special groups. For example, if you have an investment club, a real estate investment club, and there's enough people in there that are interested in setting up a self-directed retirement account, we'd be more than happy to have a conversation with you, and possibly flying or having somebody come out to one of those meetings to answer any questions live and in person in regards to questions they may have in regards to self-direction. Now let's take a look at what is the significance of the tax deadline. Well, I'm going to cut to the chase. April 15th, or in other words, the tax return due date for individuals is also the deadline on when IRA contributions can be made. April 15th is also a deadline for some employers entrepreneurs, self-employed individuals, to be specific, or sometimes even corporations that do not have any employees, or may sometimes even have employees. Their tax return due date is April 15th. March 15th just rolled around, and those are for your partnerships and S-corps. Tax returns are very important for us to know. Why is that? Because those are the deadlines to make contributions to retirement plans. The focus of this particular course is focusing on individual retirement arrangements. In other words, individual accounts. April 15th is the typical tax return due date for individuals, and that is, again, also the deadline to make an IRA contribution. Now, making IRA contributions can be used, may be used, if it's the right type of IRA, to reduce taxable income via what we call a tax deduction. In other words, let's say somebody makes $100,000 for, as a whole number, right? And then somebody makes a $2,000 contribution, or in this case, $5,000. Let's say a $5,000 contribution. It's a little bit larger amount. Just make $100,000. $100,000, $5,000 contribution. Instead of getting taxed at $100,000, you'll only get taxed at $95,000. That's one of the biggest benefits, and a lot of individuals typically look for. When I say IRA contributions may be used to reduce taxable income, that's what I mean. Once the contribution is made into an IRA, the earnings on the investments grow tax-deferred. What does that mean? The taxation on the earnings is postponed until somebody distributes it. In other words, what's the moral of the story? Well, don't distribute it. That's why retirement plans are not touched by most investors. Why is that? Because it's one of the few accounts that you have that's growing on a tax-deferred basis. You can prolong your agony of having to pay tax until such time that you take it out. But there are rules on how much you can put in. In other words, there are rules on the limits on contributions, and that's one of the things that we're going to try to cover in this particular seminar. Now, depending upon the type of IRA you choose to contribute to, there are IRAs out there that in which the individual does not use the contribution as a tax deduction. In other words, you're going to pay taxes on the contribution that you're making. You're not going to use that as a tax deduction. One of the biggest benefits of that is that if the contribution has been taxed already, you should be able to take it out, no tax, no penalty, because you should only get taxed once, right? And that IRA that we're talking about is what we call a Roth IRA. Contributions to a Roth IRA, once contributed, can be distributed at any time, tax-free as well as penalty-free. Now, what's the benefit of the Roth? The Roth IRA also has earnings growing on a tax-deferred basis, meaning that the earnings that you receive in the IRA, as long as you don't touch it, as long as you don't take it out, continues to grow without getting taxed. In other words, hopefully it's growing a lot faster, and hopefully it's growing, in this case, a lot faster. And that once you take it out and if you satisfy certain criteria, the distribution will be tax-free. That's a big difference. Not only are the earnings growing tax-deferred, eventually the distribution of the earnings could be distributed tax-free. Why only the earnings? Because keep in mind again, contributions have been taxed already. We're only dealing with the earnings. So it's either you contribute to a traditional IRA, which you postpone taxation, but later on you're going to get taxed. In a Roth IRA, when you make a contribution, you don't get it. You don't get to avail of the tax deduction. In other words, the contribution can be distributed at any time. However, the earnings are growing on a tax-deferred basis and eventually will be distributed tax-free if the individual waits long enough to satisfy certain criteria. Now, again, let's take a look at an overview of the two different types of IRAs that I've talked about in greater detail. In a traditional IRA, there is no income limit to make an annual contribution. In other words, you can make $1 billion. You can make a traditional IRA contribution as long as you have enough earned income or taxable compensation. That's what the IRS calls it, but I'm going to further define it as earned income. And we're going to take a look and break down for you what is and what isn't earned income. Contributions to a traditional IRA may be tax deductible. No reason why I say may be is because there are stipulations that you have to satisfy in order for you to be able to use that contribution as a tax deduction. One of the biggest factors that you need to be able to answer is, are you covered by an employer-sponsored plan? That term covered in the retirement industry means, are you participating in another employer-sponsored plan? In other words, like a 401k plan. one of the most common ones. A 403B plan, which another term for that is a tax-sheltered annuity or tax-deferred annuity, for, let's say, a tax-exempt hospital, a nonprofit hospital, or a teacher. Those are the types of plans they typically have. And last but not least, a governmental 457B plan. In other words, it's like similar to a 401k plan. If you're contributing to it, you're getting the portion deducted from your paychecks, or you're deferring taxation on it. That is what we call an employer-sponsored plan. If you're participating in one of those, you might want to ask questions with your tax advisor to determine whether or not your contribution is tax deductible. The biggest factor that if you are covered by an employer-sponsored plan that will determine whether or not it's deductible or not is what we call your modified adjusted gross income, and we'll take a look at what those modified adjusted gross income thresholds are to determine deductibility. Why is that good to know? Because if you can't use your contribution as a tax deduction, then you might want to consider another type of IRA, maybe what we call the Roth IRA. And if you're not eligible for the Roth and you can't use it as a tax deduction, you can still make the contribution. Why is that? Because by making a contribution to a retirement plan, at least the earnings are still growing tax deferred, even though the contribution that you made will not be used as a tax deduction. Again, the earnings are still growing tax deferred on this particular account. So there's a lot of questions a lot of people typically have in making the decision, should I contribute to a traditional or should I contribute to a Roth? In a nutshell, if you're contributing to a traditional, make sure that you're able to use it as a tax deduction. If not, consider the Roth. If you can't make the Roth contribution because you're not eligible for it, well, then you can still make the traditional again. You just might want to keep track of the dollars that are being contributed and not used as a tax deduction. Why is that? Because if you make that contribution and you didn't use it as a tax deduction, you might want to track it, because if you didn't track it, when you distribute it, you're going to get taxed on it again. There's an IRS form called an IRS Form 8606 that must be filed in the year that non-deductible contribution is made. Okay, I'm giving you a mouthful of information. A lot of you folks are probably jotting down questions. Would love to answer your questions later on. Now, overview of traditional IRA again. Sorry about that. No income limit to make an annual contribution. Contributions are potentially can be used as a tax deduction. The earnings do grow tax deferred. Now, here's another stickler about traditional IRAs. The contributions cannot be made the moment a person reaches age 70 and a half. As a matter of fact, to be specific, at any time during a calendar year, if a person is going to turn 70 and a half, they can no longer make a contribution for that year. So if they're born, let's say in February of a particular year, and they're going to turn 70 that year, they can no longer make a contribution for that year. Why is that? Because they're going to turn 70 and a half that year. Now, if they were born in October, their birthday is around October, obviously, they could still make a contribution for that year because they will not turn 70 and a half until the following year. Now, so the determination of the age 70 and a half is very specific, especially for those individuals who are wanting to make a contribution. They're saying, can I make a contribution to a traditional IRA if I'm 70 and a half at any time during the year? The answer would be no, because if you turn 70 and a half at any time during that year, you can no longer contribute for that year. Another thing about traditional IRAs, it is subject to what we call required minimum distributions. Required minimum distributions mandates an individual to take a minimum amount, a small amount every year. Uncle Sam is basically saying, I've allowed for you to allow these assets to grow for an indefinite period of time. Well, the definitive date is age 70 and a half. Once you turn age 70 and a half, now you're going to have to deplete that account. We're not going to force you to deplete it completely, but you have to take a minimum amount every year. Now, what's the repercussions for not taking it out? Well, if you don't take it out, there's a 50% penalty on the amount that should have come out. In other words, you are going to get penalized if you don't distribute the minimum amount by the prescribed deadline for required minimum distributions, which is typically December 31st of every year. All right. Now let's take a look further in how much can be contributed to an IRA. A recap again. What is the eligibility requirement for a traditional? Age 70 and a half rule. The year that you turn 70 and a half, you can no longer make a contribution. You must have taxable compensation, in other words, earned income. Another definition of that is wages for services performed. So if you work for an employer and you get a W-2 at the end of the year, you have wages. It just so happens that the wages that you receive must be enough comparatively to support the contribution. So if you want to make a $5,500 contribution, I hope you have at least $5,500 in earned income. So if you have $2,000 in earned income, well, you can't make the full maximum contribution for the year because you only have $2,000. That lowers down your limit to the amount of earned income that you receive for the year. The beautiful thing about a traditional IRA, again, is that there is no maximum income limit. In other words, you can make $1 billion and still make the contribution. What that income limit applies to is whether or not you can use that contribution as a tax deduction, and we'll take a look at a chart to illustrate to you what you typically have to go through to determine whether or not your contribution is tax deductible or not. Now, there are certain situations where you have a couple, one is working, the other one isn't. Well, the other one who's not working deserves to have a retirement plan as well. So according to law, as long as the married couple files a joint tax return, in other words, they combine their income into one tax filing, it doesn't matter anymore who earned the income because both of them deserve to have a retirement plan as long as the earned income that's being reported on that tax return is enough. Or in other words, they have enough earned income to support the contribution. Now, there may be some cases where one is age 72 and, they're still working, as an example, and they still file a tax return, they have enough earned income, although they cannot make a contribution themselves because they're over age 70 and a half. What about the spouse who is, under the age of 70 and a half, but they both have enough earned income in their jointly filed return? Well, the one who is young enough to still make a contribution can make a contribution because as long as they're under age 70 and a half and they have enough earned income, that person can make that contribution. That contribution being made to that other individual is what we call a spousal contribution. Now, don't get bogged down on the term. The term just depicts the fact that it's a contribution being made for a non-wage earning spouse that is eligible to make a contribution by virtue of the couple filing a joint tax return. In other words, they have enough earned income because of that, and the contribution is being made for that non-working spouse. Now, one of the main important things that you need to know is that contributions to IRAs have to be made to each individual's account. You cannot have a joint IRA or else it will be called a JRA. It is actually an individual retirement arrangement. If you're going to make a contribution to one spouse, they have to establish their own individual retirement arrangement, whereas the other spouse also has to establish their own, and contributions have to be appropriately made in each of their corresponding IRAs. The contribution limit, however, applies individually to each individual. So in other words, if let's say the contribution limit is $5,500 or $6,000 in some cases, all right, well then maximum contribution for one spouse is $6,000, maximum contribution for the other is $6,000. In other words, it's not a combined limit, it's an individual's limit. All right. Now let's take a look at what happens to an individual who is considering making a contribution and they're asking, is my contribution deductible? Now, again, if an individual is not covered by an employer-sponsored plan, this rule doesn't even apply. You can make $1 billion if you're not covered by an employer-sponsored plan. Not that you need one. Your contribution can automatically be deductible because you don't have an employer-sponsored plan. However, if you are covered by an employer-sponsored plan, like a 401k plan, a 403b plan, governmental 457b plan, a SEP plan, a simple plan, you might want to ask your tax advisor and, voice out the fact, I'm covered by an employer-sponsored plan. Is my contribution tax deductible? The determining factor on whether or not your contribution will be deductible or not is based out of your modified adjusted gross income. In other words, take your taxable income, reduce it by certain adjustments such as your 401k contribution, if you have a cafeteria plan at work, meaning, the deductions from your paycheck from health insurance programs, or if you have a high deductible health plan, again, the contributions that are being made through that, Section 125 plan, a flex plan, or maybe even if you're a self-employed individual and you made a SEP or simple contribution for yourself to an employer-sponsored plan. That all puts into account adjustments to your taxable income. In other words, it further reduces your taxable income. Why is that important? Because your modified adjusted gross income is the income after adjustments. Now, depending upon the level of your income, will determine whether or not your traditional IRA is deductible or not. Let's take a look at how we apply this to the income limits that you're seeing in front of you right now. The IRS calls this your phase-out ranges. What level of income phases out your eligibility to use that contribution as a tax deduction? Let's take a look at a single individual. Then you get the concept, I think. When we're taking a look at a single participant, single individual, and if they're covered by an employer-sponsored plan, if their income is below $63,000 for 2018, as an example, all right, not only can they make a traditional IRA contribution, they can also fully deduct that contribution from their tax return. Why is that? Because their income doesn't exceed the bottom threshold. If their income starts to exceed $63,000, only a part of their income is deductible. Once they reach $73,000 in modified adjusted gross income, their contribution cannot be deducted. Now, in other words, the moment you start exceeding $63,000, you might want to consider contributing to both a traditional and Roth IRA. Why is that? Contribute to the traditional, what you can deduct, and contribute to the Roth IRA, what you can't deduct. I hope you get the point. In 2019, it's 64 to 74. Below 64, fully deductible. Between 64 and 74 for a single filer, partially deductible. Over 74,000, no deduction at all. A good way to eyeball whether or not your contribution is deductible or not is that for a single participant, for every 1,000 that's contributed over 63, as an example in 2018, well, 10% of that contribution will no longer be deductible. It reduces your deductibility by 10%. So in other words, if the maximum contribution is $6,000, well, 10% of that is $600. Therefore, you can only deduct up to $5,400 as an example. And then from there, as it increases, it reduces that, $5,400 further the moment your income increases. For a married couple filing a joint tax return, it's between $101,000 and $121,000 for 2018, $103,000 to $123,000 for 2019. For a married married and active participant that files a separate return. In other words, they're already getting a tax benefit by filing separately. In other words, they're getting their taxes reduced by filing separately. The phase-out range for that individual is $0 to $10,000. In other words, you can't have your cake and eat it too. Uncle Sam says, we're already giving you a tax break by filing a separate return. Therefore, your phase-out range will also be lowered down to lessen your chance of a tax deduction. Now, what's the last one? Spouse of an active participant. Now, there are certain situations where you have a couple, and they're penalizing the couple for falling in love. Just because they're married, guess what? If an individual is not covered by an employer-sponsored plan, they're going to be assumed to be covered by an employer-sponsored plan if the other spouse is covered by an employer-sponsored plan. In other words, they're going to pull them into the picture just because one of the individuals in a couple is actually covered by an employer-sponsored plan. However, for that non-active participant but is deemed to be covered by an employer-sponsored plan, their phase-out range is a little bit higher. It's $189 to $199 for 2018 and $193 to $2,003 for 2019. Let's apply what we learned. Let's say you have a couple that has $125,000 in modified adjusted gross income. Let's first take a look at the one who is actually actively participating in a 401k plan. Well, for 2018, we'll take a look at the phase-out range, 101 to 121. If their modified adjusted gross income is 125, for that individual, they cannot use that contribution as tax deduction. However, at 125, what about the other spouse who may not be covered by an employer-sponsored plan? Well, 125 is well below 189 for 2018 and well 193 for 2019. Therefore, that individual's contribution is still fully deductible, that even though they're subject to a phase-out range, the phase-out range is much higher. Now, I don't expect for you to be an expert at this. I just want you to get the concept so that when you talk to your tax or legal advisor who's advising you on taxation, at least you have an idea of what they're going through to determine whether or not your contribution is tax deductible or not. Now, if an individual determines that they're not eligible for the tax deduction, but still chooses to make the contribution, well, again, if you're going to make a contribution that's not deductible, in other words, you're going to include that as taxable income for the year, if you're making that contribution, you might want to keep track of it. Why is that? Because if you don't track it, at the time you take a distribution, those dollars are going to get taxed again. What's the form that you use to keep track of those dollars that have been taxed already? Well, the IRS form that is used to track those dollars is what we call the IRS Form 8606. Hang on to that tax form. I know typically the advisor says, well, hang on to your tax return for 3 to 7 years. That's a good rule, but not for the 8606. Let's say you made a contribution in 2003. That's what we call a non-deductible contribution. And all your contributions since then have been deductible. Well, guess what? The IRS Form 8606 was not filed at all for any of those subsequent years because you only file it in the year that a non-deductible contribution is made, as well as in the year that it's distributed. So in other words, like a checkbook. The moment you make it, you don't have to file it again until you make another one or at the time that you take a distribution. So it's longer than 3 to 7 years. As a matter of fact, if you are planning on having your IRA be inherited by somebody else upon your death, you might want to tell them that you have non-deductible contributions in your traditional IRAs as well. Why is that? Because you're not going to know that. And when they take that distribution upon inheriting, they're going to pay taxes on it again if they don't have a copy of that IRS Form 8606. Well, anyway, enough said, and maybe I gave you too much more information that you care to hear about that. But at least you know that in a traditional IRA, not only can you make the contribution, you may also use it as a tax deduction. But if you can't use it as a tax deduction, you might want to ask about the IRS Form 8606. This is what the IRS Form 8606 looks like. If you want to Google it in the internet, on the tax year with it, and that should be filed with your tax return if you're making what we call a non-deductible traditional IRA contribution. Now let's take a look at Roth IRAs. In a Roth IRA, income limits do apply. It's very opposite of the traditional IRA. A good way to remember it, if there's no income limit in a traditional, there is an income limit in a Roth. In other words, there's only a certain amount of people that can contribute to a Roth IRA, the ones the IRS, actually in this case Congress, which the IRS monitors, who's rich. What defines who's rich? We'll take a look at what defines who's rich later on. All right? Contributions are not deductible. Therefore, contributions have been taxed already. In other words, individuals making a Roth contribution, if you receive the IRS Form 5498 from your IRA custodian, keep it. Why is that? Because that's your only proof that contributions have been made. The IRS, although they receive that information, is not going to track that for you. Only you, the taxpayer, can tell the IRS what has been contributions that have been paid on. So contributions on the IRS Form 5498 will be reported on Box 10. Keep a copy of that for the life of your Roth IRA. Just in case you need to take a distribution, you can touch those dollars at any time. No tax, no penalty. Here's another beautiful thing about a Roth IRA. When you reach age 70 and a half, you can still make a contribution. So in my other example, if a person was 72 years old or 74 years old, I don't quite remember which age I used, if they're past 70 and a half, if they're not eligible for a traditional IRA, they could still make a Roth IRA contribution as long as their income does not exceed certain thresholds. The difference, again, between a traditional and a Roth is that although a Roth IRA's earnings or interest on the investments grow tax-deferred, eventually the distribution of the earnings will be tax-free if a person satisfies what we call the qualified distribution criteria. Now, we're not covering distributions in this particular course, but you might want to attend one of the Entrust seminars dealing with traditional IRA distributions and taxation in the future. Now, when we take a look at Roth IRAs, who's eligible? Well, again, there is no age limit. Taxable compensation or earned income is still required. You must have wages for services performed. However, the individual is subject to income limits. We'll take a look at the income limits in a second. Spousal contributions are also available in a Roth IRA. In other words, you have a married couple filing a joint tax return. One has earned income, the other one doesn't. It doesn't matter. As long as they're a married couple filing a joint tax return, the income of one is the income of both. Therefore, that individual has to consider, did we make too much money? If we didn't, well, then you might want to consider a Roth if you don't need that tax deduction. Again, each contribution must be made to each of their corresponding traditional IRAs and Roth IRAs individually. Now, here is what determines whether or not an individual is rich to determine contribution amounts. For a single filer, it's $120,000 to $135,000 modified adjusted gross income. That's the gross income adjusted or lowered down already based out of certain adjustments: 401k contributions, cafeteria plan, Section 125, employer contributions, HSA contributions. In other words, if a person is eligible to participate in a high deductible health plan, they can bank away dollars that may go towards the deductible portion of their high deductible health plan in an account, and that is a straight line deduction on their tax return. For married couples filing a joint tax return, the dollar figures are a lot higher. It's $189 to $199. For 2019, it's $193 to $203,000. Again, for married couples filing a joint tax return, married couples filing a separate tax return, it's between $0 and $10,000. Again, Uncle Sam is saying you can't have your cake and eat it too. You're already getting a tax break by filing a separate return. The phase-out range to determine Roth IRA eligibility contribution is lowered dramatically down. Now, here are the contribution limits for the corresponding years. The year that we're taking a look at is 2018 and 2019. Why is that? Because 2018, you can still make a contribution up until when? The tax return deadline, and that's April 15th. The maximum contribution for 2018 is $5,500, which, again, could be lowered down depending upon the amount of your earned income. If your earned income is only $2,000, you can't make $5,500. You can only make up to the level of your earned income. In my example, it's $2,000. For 2019, it's $6,000. Why 2019? Because it's already 2019. Can you believe it? It's already 2000. I just have some deja vu experiences. I feel like I was just still doing a seminar for 2018, but now we're in 2019. We have to talk about it. Catch-up contributions are for those individuals who attain age 50 at any time during a taxable year. So in other words, if an individual was age 49 as of their birthday in 2018, well, their maximum contribution for that year is $5,500. But if they're going to turn 50 in 2019, they have an additional $1,000 in addition to the limit that's allowable for everybody. So in other words, for 2018, the maximum contribution is $6,500 if you're 50 and over, and for 2019, it's $7,000. Now, keep in mind, you can have both a traditional and Roth IRA because these limits are shared by both. In other words, you can make any variations of contributions to both the traditional and the Roth IRA as long as the combined total of what's contributed for every particular year does not exceed these thresholds that we're looking at. So if you're under age 50 for 2018, you contribute $2,000 to a Roth. Well, you still have $3,500 to a traditional. So on as well for 2019. $3,000 to a traditional, $3,000 to a Roth, $1,000 to a traditional, $5,000 to a Roth. And it may be that in your decision-making process, what you can use as a tax deduction will determine how much you put in a traditional and the difference in a Roth IRA. Now, what is taxable compensation? This is a snapshot or has been stripped out from IRS publication 590. In other words, the IRS actually issues a publication talking about the rules that we're talking about, and hopefully in layman's terms. But sometimes we still get questions because it's not as clear as they think they might be. What is considered taxable compensation? Wages. In other words, if you get a W-2, that's taxable compensation to the IRS. Salaries, tips, And in some cases, if an individual does not file a tax return because they don't have enough income to even warrant them to file a tax return, for some young people that may have earned income by babysitting or washing cars or having a lawn service, well, they have earned income. It's taxable. It just may not be subject to a tax because it's low enough. Professional fees, in other words, some Schedule C filers or, entrepreneurs. Commissions and bonuses, self-employment income as long as it's positive. Alimony and separate maintenance. In other words, if the receiver of alimony is going to get taxed on what they receive because the person paying it used it as a tax deduction, the receiver has compensation to make a contribution. Military differential pay. And last but not least, non-taxable combat pay. Somebody is fighting for our country. They're getting paid. It's typically non-taxable, but according to the HEROES Act, that is taxable. According to the HEROES Act, that is earned income that can be used for contribution purposes. What isn't taxable compensation? Earnings and profits from property, such as rental income, such as the sale of a property. That's not, let's say you bought the house for $100 and now you sold for $120 to $20,000. It's capital gains. That's not considered earned income. Interest and dividend income, pension or annuity income, deferred compensation. You postpone receiving that payment from an employer that you work for 3 years ago. That's not considered earned income for the current year. Income from partnerships, and last but not least, self-employment loss cannot be considered as taxable compensation. What's a contribution deadline again? It's April 15th typically, unless, of course, April 15th falls on a weekend or a holiday. Typically, the next business day is the tax return due date, but this year it's April 15th. In some cases, the IRS, which is actually headquartered in Washington, D.C., may be celebrating a holiday like Emancipation Day or Patriots Day in some parts of the Northeast. If the IRS offices are closed in those particular areas, the deadline may be extended to the following business day. But generally, the deadline to make a contribution is a tax return due date of an individual, which is typically April 15th. Now, here's a basic recap of what we just talked about. IRA contributions have a limit. Of course, they can be deposited from personal funds into an IRA in the form of cash, maybe wired or ACH, or maybe even a check. Those are cash. The tax code does limit the amount you can contribute each year, so you can't just make a contribution of any amount. There are limits, and the contribution must also be made in cash. You cannot contribute property in an IRA. That's one of the limiting factors. That is actually on Article 2 of the IRA document. Contributions can only be made in cash. The deadline again is April 15th, or the tax return due date. Contributions that are made are reported to the IRS and the IRA holder through an IRS Form 5498. So if you don't receive a 5498 for a contribution that you made, you might want to ask for one. And last but not least, if an individual makes a contribution called a non-deductible contribution, in other words, a contribution you cannot claim for a tax deduction, you have to file an IRS Form 8606 to keep track of those dollars. That's your tracking mechanism, so that when you take those dollars out, you won't get taxed again. And again, consult with your tax advisor. Additional ways to reduce your taxable income. Again, a high deductible health plan. If you're covered by an eligible high deductible health plan through your business or through an employer, you are eligible for contributing a health savings account. But depending upon the type of plan that you have, whether it be a family plan or a single plan, there's also a limit to that. Those contributions that you make to those accounts are a straight line deduction on your tax return. Or if the employer allows you to contribute through your cafeteria plan at work, which is also the same plan that is used for health insurance premiums, that is already reducing your income. Business owners may want to consider establishing an employer-sponsored plan, such as a SEP plan. Simple plans can no longer be established for 2018 because the deadline of that would have been October 1st. But for SEP plans, employers can establish and make that contribution up until their tax return date plus extension. So April 15th, if you're a Schedule C filer, sole proprietor, the maximum contribution is up to the smaller of 25% of your income up to a certain level. It's around $56,000. So in other words, you can shelter up to $56,000 if 25% of your income as an employer would result in that dollar figure. That's a substantial reduction of your income that's subject to tax and also that contribution is made into your account growing tax deferred. That's something you might want to talk to your tax advisor about if you do have a business and you want to shelter some cash for your own retirement savings. However, here's a stickler. If you do have employees, whatever percentage you contribute to yourself must be contributed on behalf of the employees as well. But if you don't have any employees, there are a lot of entrepreneurs out there, consultants, whoever it may be, that wants to contribute to a retirement plan. Well, you have an opportunity to reduce your taxable compensation and by sheltering that as a contribution to a retirement plan. The tax savers credit is also one of those features that a lot of people miss out on. Now, when you're taking this course, don't just take it for yourself, but take it also for your family members. You may have some family members that have earned income, but they don't have enough money to contribute to an IRA. It doesn't prohibit you from making a contribution on their behalf to a retirement plan as long as they're eligible to make a contribution. And they, being that their income might not be as high, may be eligible to what we call the tax savers credit. If they're eligible for the tax savers credit, well, they can actually use a portion up to 50% of any contributions that are made up to $2,000. In other words, $1,000 can be used as a tax credit. Not a tax deduction, but a tax credit. A tax credit reduces the amount that you would owe. It doesn't just reduce the amount that you will be subject to tax. That's what that tax deduction means. A tax credit means it will deduct it from how much you owe. It's a bigger bang for your buck. Contributions being made to those particular accounts, I view it sometimes as you're contributing an inheritance for a family member that's eligible to make a contribution but cannot afford to make a contribution for themselves. Again, make the maximum contribution to a traditional IRA if you're eligible for a tax deduction. Again, depending upon whether or not you're covered by an employer-sponsored plan, and if your income falls within the income limits, you might want to consider making a traditional IRA contribution and reduce your taxable income further. All right. Now, if you want to establish an IRA at the Entrust Group, annual contributions are not the only way to fund it. You can also move IRAs at other institutions. You don't have to move all of it. You can just move a portion of it to the Entrust Group to invest in an alternative investment that they're not willing to hold someplace else. Or if you have a rollover IRA, which was rolled over from a 401k plan, 403b, for governmental 457b, and you wanted to buy a piece of real estate, just roll over the amount that's going to cost you to buy that piece of real estate over to the Entrust Group and facilitate that process, whereas they couldn't facilitate it someplace else. Now, if you're interested in doing something like that, how do you do it? Well, you open up an account at the Entrust Group. You fund your account, again, via a contribution that we talked about, or a transfer from another IRA of the same type, or a direct rollover from a 401k plan of a previous employer. In other words, you must have satisfied a distributable event, either quit or you reach normal retirement age or the plan terminates. Those are types of distributable events. Consult with your employer. If you've reached one of those events and you have access to your 401k dollars, you can fund your Entrust IRA with that. Traditional IRA, pre-tax assets that have never been taxed before will go to a traditional. But if you have a designated Roth account in that 401k plan, you can roll that into a Roth. You'll have two IRAs at the Entrust Group. From there, once you fund your account, well, you just instruct us on what asset you want to buy. You want to buy a piece of real estate? You want to buy precious metals? Of course, you have to find the real estate, right? We also have a precious metals portal that basically connects you with dealers that are knowledgeable about what type of precious metals you can hold under an IRA, and it's up to you to choose which one you want to deal with, as well as the depository institution that will hold your precious metal. Other types of investments that you could, seek out or research are, private placement notes, whatever it is that you want to hold under an IRA. As long as it's allowed, you can hold that under your Entrust IRA. All right. It's a three-step process. Establish, fund, and then invest. You can set up your account as easily in under 10 minutes through what we call the Entrust portal. It's www.theentrustgroup.com /open new account. There's dashes in between open-new-account. Or just go to our website, www.theentrustgroup.com. You, of course, are going to need some of your personal information, a digital copy of your identification. It's going to be secured, last but not least, credit card information. So then we know how we're going to get paid as a record keeper for record keeping your IRA. All right, enough of me. It's time for questions. What we're going to do now is I'm going to first answer the questions that are posted on that you've typed in and sent in, and then we'll go from there. Again, we have about another 10, or I might extend it for another 5 minutes, 10 to 15 minutes to answer any questions you may have. Here we go. Okay, here's the first question. Married filing a joint tax return. Spouse is retired and less than 70 years. Husband working, age 71, has a pension plan at work. Can spouse contribute to an IRA? If so, how much? Okay, let's apply what we learned, right? So if you have a married couple filing a joint tax return, so both, the earned income is shared by both. Let's hope that they have enough earned income. The spouse is retired. Well, for a traditional IRA, one of the spouses is retired and less than 70 years old. Okay, so therefore, if they're not 70 and a half, they can still make a contribution to a traditional. They can also make a contribution to the Roth if they choose to, as long as their income does not exceed certain threshold. Husband working, age 71, has a pension plan at work. Can spouse contribute to an IRA? If so, how much? At age 71, cannot contribute to a traditional, but they can contribute to a Roth. They can also contribute to the 401k plan at work if they have one. Now, keep in mind, again, age is not a factor in a Roth, as long as their income does not exceed those thresholds for Roth IRA eligibility. So the answer for both is, yeah, you could make a contribution, in some cases only to one, in some cases to both, in some cases as well, depending upon their income. It might eliminate their eligibility if their income is too high. So you really have to take a look at each specific factor. For the 70-year-old, as long as their income does not exceed any certain thresholds, not only can they make a contribution to a traditional, which does not have an income threshold, they can also contribute to a Roth. For the age 71, of course, they cannot make a contribution to a traditional, but they can still make a Roth contribution as long as their income does not exceed that threshold. That's a mouthful. But anyway, I wanted to answer that question. Another question. I have a question. I am a current Entrust member. I have owned several properties and purchased at the time through Entrust funds. Okay, there's somebody invested in a non-traditional investment, piece of real estate, under their IRA, right? That's great. I currently own a property, not through a self-directed IRA, that I wish to convert to a self-directed IRA and have as part of my portfolio. How do I do this? Unfortunately, I have some bad news. You cannot do that because, number one, only contributions in an IRA can be invested to whatever you want. You cannot contribute property into an IRA. So, unfortunately, my response to you is that I cannot help you facilitate that because the law doesn't allow for property to be invested in an IRA. All right. That was a short answer, but hopefully to the point. There's another question here. If there are properties in a self-directed IRA, can they remain in place after we turn 70 and a half? Also, if they generate rent, can that continue to be collected? And the answer is yes, absolutely. Just because you're 70 and a half, it doesn't mean you have to close your IRA. The only thing that you might have to put in consideration is, do you want to satisfy the required minimum distribution? Okay, let me give this is what I mean by that. Some people get shocked by that answer sometimes. Why is that? Because the required minimum distribution can be satisfied by taking that distribution of that amount. Now, keep in mind that amount will still be distributed. That's distributed will be subject to a tax and subject to a tax, not only federal but also state. You might want to run the numbers. In some cases, if you're, let's say, in the 12% bracket or the 22% bracket, that's 22 of your 50% already, 22 in comparison to your 50% penalty already that you have to pay Uncle Sam. In addition to that, if you live in a state that has state income tax, there's also a percentage above that. So in other words, you're not going to be home free by just distributing your RMD. You're still going to have to pay tax on that, both sometimes at the federal and state level. In some cases, you don't have the state level because some states don't have state income tax. On the other side to that, if you don't have the cash to distribute from your rental property, as an example, well, you have the option of just paying the 50% penalty. You can find that under Internal Revenue Code 49-74. It's either you pay the tax or you pay the penalty. If there's no cash, you can just pay the penalty. You can also do a variation of the two. You can take a portion of it out and only pay penalty on the portion that you didn't distribute. See, in other words, you have many options. Just because you're age 17 and a half, it doesn't mean you cannot have real estate under your IRA anymore. You just are going to be subject to required minimum distributions. And your options to satisfy the required minimum distributions are not limited to the three that I gave you. You can either distribute the amount or keep the amount in your traditional IRA and just pay the 50% penalty. Last but not least, you can also satisfy your RMD from another IRA for a combination of all the three. In other words, take a distribution, pay the penalty on some, or maybe even take a distribution from another IRA to satisfy the RMD for the IRA that you have with the Entrust Group. So I hope I gave you maybe too much information, but at least you have options, all right? So if you have any further questions on that, please, we have an 800 line. We'd be more than happy to respond to you. And as a matter of fact, if you want the 50% penalty, I'll give you the form. The form is the IRS Form 5329, and I believe on Section 9 is where you pay the 50% penalty. By paying the 50% penalty, that RMD does not have to be distributed for that year. It just so happens that that amount will be included in the calculation for the subsequent year. But in some cases, some people, and I've heard this many times, I really don't need this money. I'm just saving this, just to collect the rent. But eventually I want the property to be handed to another generation, which is another seminar in itself. Because the recipient or the beneficiaries can establish an inherited account and maintain distributions, incremental depletion of that IRA for the rest of their life. That's a huge statement, folks. It's called legacy planning. That may be another seminar that we can create for you folks if you are interested, right? Again, if at any time in our conversation you have a topic that you're interested in, like what I talked about, shoot us an email. I'll be more than happy to create those seminars for you and create some education on what the tax law says, and then you can strategize from there with your tax or legal advisor. All right, next question. Can rental income from real estate investment flowing into my qualified LLC be offset by an IRA contribution to Entrust? I'm missing the question. Can rental income from a real estate investment flowing into my qualified LLC, which, by the way, needs to flow back to the IRA, be offset by an IRA contribution to Entrust, or is it already sheltered from federal and state income tax? You can't use the interest in an investment in an IRA and consider it as making your IRA contribution. Why is that? Because interest in an IRA has not been taxed before. Right? So if you take that distribution, now you have been taxed on that. Hopefully you have enough earned income. If you want to use that as a contribution, you can do that. But you can't just say, oh, interest that's coming in is now a contribution to my IRA. Unfortunately, you cannot do that because, again, interest is tax deferred. It's never been taxed before. So you can't call it as a contribution to your IRA. Yeah, unfortunately, you have to take either assets from other places or take a distribution of that interest, which will be taxable to you, and then use that as a contribution. That you can do. But without taking the distribution, you can't just reclassify interest in an investment, unfortunately, as a contribution. I hope that answered your question gracefully. All right, question 2. Can rental income from a real estate investment flowing into my qualified LLC be contributed to my KEO plan within the standard limit? Does that income have to go into an Entrust or another qualified retirement plan? Rental income going into an LLC owned by an IRA must flow back to the IRA. In other words, an IRA invests in an LLC, purchases property. The property has rental income flowing back to the LLC. That rental income has to flow back to the IRA. It cannot interact with any other retirement plan because it's still under the umbrella of the IRA as interest that has been tax deferred, right? So you cannot use that as a contribution for a profit sharing plan. When you say KEO plan, those are your old HR 10 plans. They're all either profit sharing or money purchase pension plans. The earnings in an IRA cannot be contributed to a KEO plan. You can roll it over to your KEO plan. In other words, with the passage of EGTRA in 2001, effective 2002, IRAs can now be rolled into a profit-sharing plan. So if that's something that you want to do, you can do that, but it's not going to be considered as a contribution to your KEO plan. I hope that helps. All right. Is foreign income considered earned income? It depends upon whether or not your foreign income is actually reported in the United States as earned income being taxed in the United States. So that's something you might want to chat with your tax advisor about. There are some incomes that individuals earn outside the United States that are U.S. income. It just so happens it's earned in outside the United States soil, but it's still filed in the tax return of an individual. So that's something that you might want to consider talking to your tax advisor, because they're the experts at that. If it's taxable compensation in the U.S., earned income, you paid Social Security tax on that, yeah, it's earned income. So, but that's not your response from me. But again, the response from me is talk to your tax advisor and how that's reported. All right, married filing jointly spouses getting disability pension. The pension is taxable. Pension income is not considered earned income. All right, and it's less than 70 years old. Husband working at age 71 has pension plan at work. Both getting Social Security. Can spouse contribute to a traditional? And if so, how much of that be tax deductible? Well, keep in mind again, Social Security income in that list is not earned income. Pension income is not earned income. So is there any earned income reported in the tax return? That's the first question. If there is earned income in the tax return, number one, the response first to are you eligible to contribute? The answer would be for the 70-year-old, yes. For the 71-year-old, no. Okay. For traditional, how much of that is deductible? I don't know, because I don't know what the adjusted gross income is. So it depends upon their adjusted gross income, and that chart that I provided earlier in previous slides will determine whether or not that contribution is deductible, given the fact that the individual is covered by a pension plan at work. That would be something the steps to next steps for you is to gather all your data, take it to your tax advisor and say, do I have earned income for the year? And if so, how much? Number two, what is our adjusted gross income? And last but not least, based on the chart, am I covered by a pension plan? Am I participating in a pension plan? And is my income within the thresholds to use it as a tax deduction? Those are the pieces you might want to bring to your tax advisor to make that determination of whether or not it can be used as a tax deduction. Do you have an advisor I can talk to at another time regarding an IRA having a single member LLC as an investment? We don't have investment advisors, but we do have business development representatives that can answer general questions for you. So if you call our 800 number, they'll be able to answer some general questions you may have. Can Entrust convert a traditional IRA into a SEP IRA? The answer is yeah, because a SEP IRA is nothing more than a traditional IRA. It so happens that we delineate the two at the Entrust Group. So again, if you have a traditional IRA, you want to roll that into a SEP IRA, yeah, it's basically just rolling it or transferring it to a traditional IRA. SEP and traditional IRAs are one and the same for all intents, according to the law. It just so happens that financial institutions treat them a little bit separate, because SEP IRAs are reported differently and the maximum contributions are a little bit more. So the answer to your question, yes. Can I purchase a property from a family member? The answer is no. Unfortunately, there are what we call prohibited transaction rules, and you cannot interact with these, and one of them is what we call a family member, a lineal ascendant or lineal descendant. I guess let me qualify the answer. The lineal ascendant depends upon a family member, because if it's a sibling, a cousin, that's not a family member according to the IRS. Lineal ascendants meaning parents, grandparents, children, grandchildren, and the spouses of children and grandchildren. Those are lineal ascendants and lineal descendants. But if you want to sell it to your brother, cousin, that they're not family members. The IRS has a wonderful resource. If you just type in prohibited transactions FAQ and Google it, and then it'll bring up a section of the IRS website FAQ. You'll be able to find that answer right there. Can Entrust open up a SEP IRA? The answer is yes, sir. We could. Yes, sir. And the reason why I'm saying sir is I see their names. Right? Hopefully, I'm correct. Right? What triggers UBTI in an investment, and does Entrust file the tax return when it does? UBTI is what we call unrelated business income tax. If there is an asset or an investment under an IRA that generates income that is considered a trade or a business, and let me give you an example. Let's say an IRA invests in a company that is a restaurant. A restaurant is a business, or a laundromat. I'm just giving you examples of businesses. The income received by that business cannot have a competitive advantage over another business that is not held under an IRA. Therefore, that income received from that business by the IRA is subject to a tax. It's called unrelated business income tax. That tax on that will be subject to trust tax rates because IRAs are considered trusts. And the IRA has to file what we call the IRS Form 990T. Just to answer your question, we do not prepare the IRS Form 990T. We leave it up to the taxpayer, the IRA holder, to have their tax advisor prepare the IRS Form 990T because we don't have anything to do with that particular investment. We're just holding that investment as, from a custody perspective so you don't get taxed on it to keep the investment tax deferred. However, once the 990T is completed, and by the way, the IRA would have to get its own EIN number so that the IRA holder is going to have to go to the IRS website, get an EIN for the IRA, which, if you need some help doing that, we can assist you. We can direct you to how the IRA could actually get an EIN number. It doesn't take that long. That EIN would have to be on that 990T, so just in case there are any questions, they know who to go back to in regards to that 990T that was prepared. Again, I hope I answered your question. Publication 598 from the IRS is a good reading for unrelated business income. That's what. But there are other incomes that the IRAs receive that is not taxable. For example, rental income is not taxable. Royalties, rents, royalties, dividends, interest, those are all passive income, so therefore it's not taxable to the IRA. So if the IRA owns rental properties, income of that, not taxable. However, if the income is derived from a trade or a business, then that income is taxable. IRA would have to file an IRS Form 990T if the gross receipts, which means income less cost of goods, an example, that would be the gross definition, exceeds $1,000, then it would have to file a 990T. It's $1,000 or more need to file a 990T. But if not, then not an issue. I hope that answers your question. All right. Can I download Form 5498? The answer is sure. You can go to the IRS website and download IRS Form 5498, but it'll be blank. The IRS Form 5498 is issued by your custodian. That's one of the roles we play. That's what we get paid to do. We tell the IRS, we send an electronic tape for all of our IRAs to the IRS. This person made a contribution. This is their value of their IRA. Did a conversion, rollover. We're the Entrust Group as a custodian. That's one of our functions, or whichever custodian you work with. Is rental income taxable under an IRA as long as the asset that was used to purchase the property was fully funded by the IRA? It's not taxable. However, if the property was partially purchased using IRA dollars and the IRA got a loan called a non-recourse loan, the portion that was used, the percentage it was used to borrow, will be applied to the income received for the year to determine what's taxable and not taxable. All right. If you folks have further questions in regards to that, we'll be more than happy to do a seminar on UBTI. If that's a it doesn't have to be a long seminar, but we can definitely cover that. Can your income eligibility for Roth change from? Yes, your income from year to year will change. The income thresholds for Roth's eligibility can also change depending upon the cost of living adjustments issued by the IRS. So every year you have to take a look at where you're at, right? If you open a Roth IRA and meet the requirements, but in future years you exceed the income, how is that looked at? Oh, that's a big confusion that a lot of people have. It's only looked at per year. So every year for this year, if you're eligible for this year, well then that's done for the year. If your income increases in the future, but it doesn't apply for the current year. So it's looked at each year separately. All right. It is the income threshold is not defined on whether or not you can hold a Roth IRA. The income threshold defines on whether or not you can contribute. But once you contribute and you're eligible for that year, that cannot be taken away from you. I hope that answers your question. Per RMD, our residential rental, i.e. said self-directed contents fixtures required to rent property allowed as tax credits. In other words, the asset is reduced in value. Property managers. Oh, is that a part of the expenses? That would be something you might want to contact your tax advisors on when they start doing the profit and loss statement for that particular rental, right? And that's essential for eligibility folks who are listening. Why is that? Because when you're considering the value of your IRA, what his question is reduce income. The answer is it could reduce income, but the value of the actual asset itself, the fair market value of a piece of property, will not be affected by those expenses that are paid. Why is that? Because it's not we're not dealing with the value. That's not dealing with the value. That's dealing with the income. The value of the piece of property has its own separate value. Right? So for RMD purposes, when we start taking a look at the fair market value, the fees paid to property managers and so on is not put in consideration. It's the fair market value of the property that is used to calculate the RMD. All right. I hope that wasn't confusing. If I live outside the country and have income in a foreign country, well, I only have to pay federal taxes on my distributions. I do have an address in California, but I file as a non-resident. That really depends upon the state of California and whether or not they will determine you as a California resident. That's a tax question that you might want to ask a tax consultant about. I'm sorry, I wish I could answer that question. Not familiar enough with it, but that should be a fairly simple question that with a tax advisor. As a follow-up question, do you need an appraisal to determine the value of real estate in your self-directed IRA, so then know the required minimum distribution? Well, appraisals are a policy most, if not all, financial institutions use. Why is that? Because the custodian could be audited by the IRS. And they would typically look at the custodian and say, what valuation did you accept to calculate this required minimum distribution, as an example? Or what fair market value do you use to report the distribution? We have to use the most prudent form of valuation, and an appraisal is the most prudent one. And because, again, if we didn't report it correctly, we basically just an accomplice to tax evasion at that point. That's why most custodians will ask for an appraisal. Yeah. How does rental income flow back into the IRA from the LLC? Well, the general manager of the LLC would need to give that money back to the IRA. Because keep in mind, if those assets flow from the IRA to the LLC as an investment, earnings from that investment must flow back to the IRA. It cannot sit in that LLC indefinitely, right? Because keep in mind, who owns that LLC? Who's a member of that LLC that's an investor? It's the IRA. The LLC and the IRA are separate. Yeah. Does that mean I have to transfer money back from the LLC to the IRA account? Yes. Because if you move that money to yourself, that's a distribution. That should be taxable. And if you can't just pay directly out of the LLC to somebody else and not report that to the IRA, because they wouldn't know that a distribution took place. Because that should be reported in an IRS Form 1099-R. Because if the LLC was owned by somebody else, guess what the other LLC general manager would do? Shoot that money back to the IRA before a distribution takes place to cut the 1099-R. So I hope that answers your question. I have retired and have an HSA and would like to continue to contribute. Can I contribute rental income to my HSA and deduct it from my taxes? Well, as long as you're under the age of 65, not collecting Medicare, well, then you can take money out of your IRA, rental income from your IRA. Of course, you're going to get taxed on it and contribute that to your HSA. But also, one of the things you might want to put in consideration, I hope that answered your question first, because keep in mind, you cannot have an HSA if you're eligible to receive Medicare. So when you say retired, I don't know how old you are. And So if you take a distribution from your IRA, typically you will be taxed on it. But there's a one-time, it's called a qualified HSA funding distribution that allows for you to distribute from your IRA, contribute that to your HSA up to the maximum amount that you're allowed. So pick the largest one, and it'll be tax-free from your IRA. Talk to your tax consultant about qualified HSA funding distribution. In other words, you're just taking a distribution from your IRA, funding your HSA. That distribution from your IRA, if it funds your HSA for the first time, and then the only time, lifetime, that distribution will be tax-free. It should be on Schedule 1, I believe, line 4 of your IRS Form 1040, right? And just so happens that I knew that. I'm not offering tax advice. I'm just pointing you where to go, all right? So to answer that question, are you eligible to contribute to an HSA? And if so, you can take a distribution from your IRA, contribute that, and if you've never availed it before, that should be tax-free within the limits, right? Can I partner with my self-directed IRA to purchase a property, or is that a prohibited transaction? The initial purchase of it is not problematic. The ongoing transactions that you conduct, you need to walk the fine line. Why is that? If you bought a piece of property 50% yourself and an IRA, you're engaging with a third party. That's not the prohibited transaction. Incomes, expenses, everything has to be split 50-50 in order for it to be unblemished, or in other words, there's no conflict of interest. That's where a lot of people run into a foul. So in other words, to answer your question, can partnering with yourself, theoretically, a lot of people in the industry does not seem to think so because you're interacting with a third party. How you administer for that particular transaction for the life of the IRA, you might want to walk that fine line that, since whatever the percentages of the funding, that the income and expenses are also appropriated proportionately. That's the important part, right? So I hope that answers your question. If I partner with my IRA 6335, can I contribute 35% percentage of income? If I partner with my 6535 IRA personal money, can I contribute my 35% percentage of income to a Roth IRA? No. Contributions to Roth IRAs can only be made in cash. Right? Husband was W2 earning $30,000, wife is 40. Is it possible to do a Roth at all? The answer is no, unfortunately, because the $300,000 and 40 is 340 modified adjusted gross income. Of course, I'm assuming that you don't have a whole lot of deductions. It takes, or if you're filing a separate return, $40,000 exceeds the $10,000 threshold for a married couple filing a separate return. However, here's another way to do it. You can make a contribution to a traditional IRA and then convert it to a Roth, right? In other words, you contribute an amount to a traditional and then you convert it to a Roth. You just might have to consult with your tax advisor on whether or not that distribution for the conversion is going to be subject to a tax, all right? So if you can't make a contribution to a Roth, well, you can make a contribution to a traditional and then just do a conversion. Or if you're an entrepreneur, set up your own individual 401k plan. If you don't have any employees, create a designated Roth account. Or if you work for an employer and your employer has a 401k plan, ask them if they have a designated Roth account in the 401k plan and then make a designated Roth account contribution there. So those are your options. Property manager collects rent. Can the county property taxes reduce the rental income? Yeah, that'll be a part of the P&L of the rental property, right? Keep in mind, rents received by IRAs are not taxable anyway. That's why it all offsets itself. It's not a big issue. What reduces rental collected income? Since you said property management costs are not devaluing the property, it doesn't devalue the property because the maintenance of that property has nothing to do with actual. When you get an appraisal of a piece of property, they don't put in consideration the property management fees that have been paid in that account. It's just a part of having a piece of property. So in other words, if you bought a house at $200,000 and you've been paying property taxes on that, they're not going to say the value of the house is $200,000 less property taxes. Or if you were paying somebody to maintain that house and you decide to sell that house, the property value is not going to be $200,000 less what you've been paying the property management fee. It's the same principle. So when the IRS says if you bought a piece of property with your IRA, the expenses have to be paid from IRA assets. But when you sell it at fair market value. That's how property management fees do not affect fair market value when taking a distribution of it. I hope that answers all your questions. It is 12:21. I extended the question and answer portion a little bit further. We thank you for attending today's course. My name is John Paul Ruiz again, Director of Professional Development here at the Entrust Group, and hope to have you again in a future Entrust Group seminar. Thank you, and please give us a call if you would like to establish an IRA at the Entrust Group or have any further questions. Goodbye.